Hello and welcome. You are watching In Your Interest here on News 9 Live. I am Krishna Kumar. First up, a check of all our headlines. India stock markets tumbled on Tuesday with the Sensex plunging over 900 points and the Nifty falling below the 24,500 mark, pressured by weak corporate earnings and continued selling by foreign funds. Sensex down by over 1% to settle at 80,220, while the Nifty plunging over 300 points or 1.25% to close at 24,472. The market capitalization of all listed companies on the Bombay Stock Exchange dropping by over 9 lakh crore rupees to about 440 lakh crores. Hyundai Motor India, the largest public offering in India's history, made a rather underwhelming debut on Dalal Street. The stock opened at 1,934 rupees, which is 26 rupees or over % below its IPO price of 1,960. After the sluggish start, things got worse as the stock tumbled, dropping by as much as 7.5%. However, there was some recovery when global brokerage firm Nomura stepped in, initiating coverage on Hyundai Motor with a buy rating at a target price of 2,472. Food delivery company Zomato reports nearly 400% growth in its consolidated net profit at 176 crore rupees compared with 36 crore rupees a year ago. However, the profit after tax number missed the estimates of analysts of 260 crore rupees. Revenue from operations rose nearly 70% to nearly 4,800 crore rupees. The bottom line growth was driven by a steady increase in food delivery margins and quick commerce business continuing to remain near break-even. Pepsi India bottler Varun Beverages' September quarter profit exceeds analysts' expectations as healthy demand for soda in its international markets helped outweigh a monsoon-hit domestic market. The company's net profit rose nearly 25% to over 600 crore rupees or nearly $74 million, beating expectations of 576 crore rupees. The company follows calendar year for the purpose of reporting earnings. Hardeep Singh Puri, the Minister for Petroleum and Natural Gas, addresses the recent rise in crude oil prices, stating that there is no shortage of oil globally and that prices are expected to fall soon. Speaking to the media, the Union Minister highlighted that factors like the ongoing conflict in West Asia and voluntary cuts in oil production are currently influencing global oil prices. We begin this edition of In Your Interest with a close look at what's going on in India's stock markets. Why are foreign funds flying away from India's stock markets? Foreign portfolio investors or FPIs seem to be losing their appetite for Indian stocks, especially for the month of October, with heavy selling by them taking center stage. Now, this marks a sharp U-turn in from September, as FPIs have been offloading significant amounts of Indian stocks driven by concerns over high valuations and rising geopolitical tensions across the world. Just earlier, FPIs were pouring money into India's markets after the US Fed slashed interest rates by 50 basis points. But that momentum has now flipped. Now they're pulling out and they're redirecting all those funds to stocks in China's stock markets. What exactly is driving this switch? Recent moves by China to stabilize its shaky property and capital markets have rekindled investor confidence in China's potential comeback. In a bid to support economic recovery, China's central bank slashed its key lending rates by 25 basis points, bringing them to fresh lows, giving a further boost to corporate profit expectations in China. As of the 21st of October, foreign portfolio investors at FPIs have withdrawn a staggering 82,000 crore rupees or around $10 billion from India's stock markets, the highest ever monthly outflow on record in history. For context, the last time we saw outflows at this scale was during the pandemic in March 2020 when FPIs pulled out nearly 66,000 crore rupees. With the FPI tide turning, the question now is what's next for India stock markets? And more importantly, what's next for retail investors like you who are watching this broadcast? To help us get some answers, we have a very special guest joining us. Now we have Mr. Rohit Srivastava, founder and market strategist, IndiaCharts.com, joining us here live on In Your Interest. Thank you, Rohit, for taking time out to be with us here on the show. First question I have to ask you is this. This is the highest ever pullout by foreign portfolio investors from Indian stock markets on record. But they did do something similar earlier as well. But now markets are not crashing as much as they did when they pulled out money last time. And last time, when they were pulling out money in big numbers, markets were down 25%. But now markets are down anywhere between 5 to 7% because domestic institutional investors, and by that I mean the mutual funds of this country, they are somehow being able to make up for all the money lost in India stock markets.
So that's quite true. Thanks for having me. It's true that domestic investors have been on the buy side. If you just look at October numbers, it's like 80,000 crores worth of selling, 70,000 crores worth of buying by DIAs. So net difference of 10,000 crores. But if you actually look at the annual number for the calendar year, then you actually see that domestic investors have bought, over 4 lakh crores and the FIIs have sold, around 2 lakh crores. So actually the difference is huge in favor of domestic investors. So they have been the supporting part of the market. And in that sense, eventually when we come down to market analysis, what really works here is positioning and sentiment. If sentiment turns poor or if there's excessive positioning on the long side, that does bring markets down, irrespective of how much buying and selling is really happening by one or the other segment. Because if you think that there's equal buying and selling by FIs and DIs, then that's not the deciding force of where the market is headed. It's really going to be driven by fundamentals, valuations, liquidity, and what's happening in global markets. Many of those other factors. China may have been, the easy target for what has happened recently to say that we buy China and sell India, but that's not usually how global asset allocation really happens. A lot of people who invest in emerging markets simply look at an emerging market ETF or a fund and they allocate according to that. So you can increase the weightage of one country over the other, but you still keep getting flows. India's problem has been that we've really not been getting flows from foreign institutional investors. And I think a lot of that has happened since we put a brake on, taxation and a lot of the tax treaties, because we are giving a free ride to FIs on the tax side. A lot of foreign investors actually don't like the idea that, you invest in a non-tax haven where there's withholding tax. And so often they check you off that list. And that may be one of the long-term concerns that has caused inflows to really not happen and eventually leading to net sales. So that's a bigger problem. I think the recent sell-off in the market that we are really seeing is coming on the back of a lot of long positioning that has happened over the last quarter. I think not just after the elections, but also in the last month when the Fed ended up eventually cutting interest rates, right? And that caused not just US markets to head higher, but our own market stretched through September after that initial correction at the beginning of September. I think that rally got faded as we hit October because reality struck that earnings growth is still not going to pick up in the October quarter. It's still going to be slow, just like it was in June, and it's going to take a while. Though I think there are expectations that government spending will pick up in the second half and things would improve probably in December and March. But right now, for the current quarter, the expectations are bleak, and that is why there's no positive news really to look forward to.
Right.
If you looked at FII positioning in the index futures market, that's something that we track to know that is everybody bullish or is everybody bearish.
Right.
Then you'd actually be surprised to see that you had the highest long positions in the history of the index futures market from foreign institutional investors at the start of October. So when you see that kind of a long position, which means that you are excessively bullish at the start of the month, you had created a setup for a coming correction, and I think that is now unfolding into a slightly bigger correction.
The question is, how long will this continue? How long can the DIIs or domestic institutional investors hold up India's stock markets and overcompensate for all the money being pulled out by foreign institutional investors and foreign portfolio investors?
So I think unless there's really a very deep correction, and by deep we mean not just price-wise but time-wise, that would really shake up people to stop believing in systematically investing in Indian equities. That is not going to change. See, the trend towards investing in India has actually changed very, very structurally since the mutual fund sahi hai campaigns that happened between 2015 and 2018. And then furthermore, after the COVID lows, people got enthused by the idea that that corrections are short, brief, and then if you just keep buying in the long term, you're going to make money. So it's going to be very hard to shake off us. And unless you see a significant weakness in the Indian economy, or in the Indian market where people lose money for months or years, I don't think that psychology will change so easily. So you'll continue to get domestic buying. The only thing you have to be careful of, and what we are seeing right now, is corrections that happen from over optimism or positioning of traders, and that's what causes these corrections, which can eventually become good buying opportunities. But it is pain in the short term, which can continue for a couple of more weeks.
Couple of more weeks, you said. Okay, fair enough. My next question obviously is for all those people watching this broadcast, all the retail investors watching this broadcast, what should they do? What should their strategy be when it comes to investing in the stock markets or investing in mutual funds? And more importantly, should they be looking at alternative asset classes at a time like this? Maybe gold, maybe, I don't know, fixed deposits. The interest rates are high at this stage.
So fixed deposits have not been so attractive relative to equities for years now. So should we really look at shifting our portfolio allocation towards bonds? Now there may be a small case there if you're a big fund manager to have some bonds, because rates maybe in India also start going down, and then that's an attractive thing to play on. That trade definitely worked very long back in 2002-03 when the rate cycle turned in India. So for a 1 or 2 year period, bonds outperformed equities. So can we get a bit of that? It's definitely possible. Early days, but it's possible, because I do think the rate cycle in India will change. And the second impact of that is directly on gold. So you're right that gold is also a good asset allocation. The gold bull market is not over longer term. And whenever you weaken your currency, and everybody is lowering rates, so which means everybody is weakening their currency, not just India, but also various US has already done it. We've seen it in Europe. India is just going to be the last one. And when we actually lower our rates, then you'll actually see the INR weaken. So whenever a currency weakens, gold priced in that currency goes up. And if everybody is doing it, then the impact is even bigger. So yes, there's room for having some bonds and some gold in your portfolio for different time horizons. I mean, I would still believe that the long-term Indian bull market is not yet done. Which means that if prices do decline quite a bit, then there will be a buying opportunity. But if you have a 6 to 12 month time horizon, diversification into bonds and gold could be a good thing.
Okay, one last question. So does that mean that right now it'd be ideal to say that cash is still the king?
Having some cash is useful, because say if you do get a 10%, 15%, 20%, if you're really lucky 20%, but 10-15% cut in these markets, then you get a very good buying point in growth stocks. So I think this is a good time to differentiate as to whether these stocks you're owning in your portfolio are growth stocks or not, because you can have stocks at high valuations which have growth, and you can have stocks at high valuations which are purely momentum. And that segregation becomes important, because growth stocks can remain overvalued for a longer period of time. So having cash allows you to deploy money into the right areas, and corrections are a good place to actually remove stocks that start underperforming. So if you have particular levels in mind and some kind of a exit strategy also, you can clean out things which are not working and then reallocate to things which are working. That's probably what you ought to do in this time period.
As far as investing directly in stocks is concerned, what about investing the millions out there watching this broadcast, who are investing in mutual funds?
So for systematic plans and regular investment which people do from their savings should not really be an issue. 10-15% corrections are completely normal. They don't really harm the long-term growth of your portfolio. if it's fairly diversified or has the right growth stocks mixed inside it. So that I think is not going to really be a pain point for long-term investors who are regularly investing. So they shouldn't be too worried, I think, about their mutual fund holdings.
All right, they should not be worried about their mutual fund holdings. One last question. You were talking about the pain in the markets continuing for the next couple of weeks. What do you think can turn the momentum around? Because all the other factors remaining the same. The West Asia tensions continue, the Russia-Ukraine war continues, the uncertainty around crude continues, and the continuous fall of the rupee. In this context, where do you see things headed?
Yeah, so here are a lot of positives that can kick in over the next 2 quarters. One of them I've mentioned could be the government spending that resumes because it had come to a slowdown because of the elections, right? So once they find that, okay, these are the budgets which are incomplete and they start spending in the second half, that does cause some growth momentum as far as the earning cycle is concerned. Second is, of course, rates. When interest rates do start getting cut, then interest rate sensitive sectors, autos, real estate, metals, which are indirectly correlated, with the dollar and rates, all of them start doing well. So there are going to be certain segments of enthusiasm, that can show up in the coming months where you would actually want to focus. So those are going to be attractive. So the rate cycle, and then there's this last one which a lot of us don't know. Some of the pain which we may see over the next week or two may also come because US is entering its election cycle. So typically we have seen US markets correct prior to the elections and then actually do pretty well after the elections because they don't have the Indian type of government, right? Once they've elected a president, he's going to be around. It's not a coalition government. So usually things work out pretty well and you get post-election rallies. And now this time around, we haven't seen a dip yet pre-election, and that's simply because the Fed acted and got the markets up on the rate cycle. But that momentum seems to be lost. If you just look at the last 2 days of action, you can see the US market rolling over a little bit. So I think over the next couple of weeks till the 4th of November, 5th of November, elections actually happen in the US. You will see markets under pressure, US markets, global markets also under pressure, and that will actually come to an end post the US election. So that will be another source of positivity that will come in after November. There's also seasonality. If you look at the seasonal pattern of Indian markets, they're usually down either between September or October. This period you often get corrections, and we've now finally starting to see it. We didn't see it in September, but November, December, Jan are seasonally pretty bullish. The cycle actually picks up through this time period, and once it does, then things do much better. So these are the couple of factors that would be a driving force for markets to resume the upward journey post I think the first or second week of November.
Okay, we will hope for that. But for now, we're completely out of time here on this discussion. Rohit Srivastava, thank you so much for taking time out to be with us on this edition of In Your Interest and helping us understand what's going on in the markets. And with that, we take a very short breather here on the show. We'll be back with lots more on the other side. Keep it with News9 Live.
Let yourself flow with the turn of each tide.
Salty winds, you sweeten your ride.
Maharashtra,
Maharashtra is the hit.
Maharashtra tourism.
Why is the state not looking at putting an embargo on that?
As a Telangana person, I will not accept.
How do ordinary folks deal with this?
Joe Biden is not going to be the Democratic presidential nominee.
I made my choice. Kamala Harris. She's experienced. She's tough. She's capable. I took on perpetrators of all kinds, predators. So hear me when I say, I know Donald Trump's type.
I am the one saving democracy.
He has tapped in to the fear and anxiety about demographic change in the US.
This polarization in the United States. Some people are even suggesting that there could be a civil war.
You are this unable to solve your own domestic problems. You have no right to claim to be anybody else in the world. And we're moving into a multipolar world where the United States will not lead.
This and more. Streaming on News 9 Plus. Subscribe and get free vouchers.
You are watching In Your Interest here on News 9 Live, and at this moment we're putting the focus on one of the biggest names in India Inc. This is Sunil Mittal, who has admitted to being conned using artificial intelligence. Scammers are constantly finding new ways to exploit unsuspecting victims, and recent trends show that they are getting more and more sophisticated. While many of us are aware of scams involving cloned voices, it's rare to hear about attempts to impersonate billionaires. In a startling case, fraudsters cloned the voice of the chairman of Bharti Enterprises, Sunil Mittal, in an attempt to con one of his executives in Dubai into transferring a substantial amount of money. Fortunately, the executive was vigilant and sensible enough to realize that it was a scam. A scam quickly unraveled. But this incident highlighted a disturbing trend in the world of online fraud. Scammers are now using advanced technologies like artificial intelligence generated deep fakes and voice cloning to deceive their victims. To help us understand this better, we have a special guest now joining us. We have Mr. Pawan Duggal, senior cyber law expert. Pawan, thank you so much for taking time out to be with us. Talk to us. I mean, it can happen to common men. They're talking about digital arrests taking place. There's daily news about, people getting phone calls and asking people to transfer money, and they do, and they lose lakhs and lakhs, in fact, in crores. But this time around, it's no less than a billionaire like Sunil Mittal, and fraudsters have managed to clone his voice and try to dupe one of his executives.
Well, clearly, you have to understand billionaires are a more fertile target than others. Why? Because they are public figures. Number two, people tend to increasingly put a lot of credibility onto them and presume that what they are hearing is indeed the voice of the billionaire. So what's currently happening with Mr. Mittal is nothing but the tip of the iceberg. Cyber criminals are getting more and more tech savvy. They are using artificial intelligence, not just for cloning voices, but more importantly, using artificial intelligence for the purposes of powering cybercrime as a service. This is getting to be a big kind of an AI crime that's begun to start happening. And I think everybody needs to be alive of that. The time has now come where we have to realize that we are now living in a new age, an age of generative artificial intelligence, but also an age which is characterized by the new cyber world order. And in this age, while cybercrime becomes a new default normal, cybersecurity breaches are going to be a lifelong companion. In a scenario like this, it will be very important that we must go ahead and inculcate an element of distrust and mistrust in whatever we see, hear, or read online. Do not go ahead and rely upon any stuff that you see, read, or hear till such time you have independently authenticated the veracity or correctness of the same. That's the new ground age reality. The quicker we start recognizing the same, the better it is. Otherwise, very quickly we are going to become very big targets of AI crimes and cyber crimes.
All right, we will leave it at that. We're completely out of time. You're on the show. Pawan Duggal, senior cyber law expert. Thank you so much for taking time out to be with us here on this edition of In Your Interest. And with that, it's a wrap here from my side. Thank you so much for watching. This is Krishna Kumar signing off.
In the heart of New York, an Indian spectacle unfolds. Step into the world of the elite saga, featuring influential Indians who've rocked the globe. From culinary geniuses,
this has been nothing less than a dream,
to the wisdom of sages.
And which is why success can never be spelt without you.
Discover the stories behind the stars. Experience the magic behind the scenes. At the first Indian event at the Statue of Liberty. Watch the Elite Saga streaming only on News 9 Plus. Download now.
Why is the state not looking at putting an embargo on that?
As a Telangana person, I will not accept.
How do ordinary folks deal with this?
Chief Justice of India D.Y. Chandrachud has nominated Justice Sanjeev Khanna as his successor upon retirement. Justice Khanna is only second to CJI Chandrachud in terms of seniority in the Supreme Court. With CJI Chandrachud set to retire on 10th November, he wrote to the Union Law Ministry starting the Memorandum of Procedure, a document which includes the process for appointing the Chief Justice of India, seeking the recommendation of the outgoing CJI. Who is Justice Sanjeev Khanna, next in line to be India's Chief Justice? News 9 Plus decodes. Born on 14th May 1960, Sanjeev Khanna enrolled as an advocate with the Bar Council of Delhi in 1983. He started his practice in the district courts of the Tees-Zari district and later moved to the Delhi High Court. He was appointed as the Standing Counsel Civil for the National Capital Territory of Delhi in 2004. He was elevated to an additional judge of the Delhi High Court in 2005 and became a permanent judge by 2006. Interestingly, he did not serve as the Chief Justice of any High Court before his appointment as a judge in the Supreme Court of India. He was made a judge of the Supreme Court on 18th January 2019. He held the post of Chairman, Supreme Court Legal Service Committee from June 17, 2023 till December 25, 2023. At present, he is Executive Chairman of the National Legal Service Authority. Justice Khanna is likely to take over as the CJI on 11th November. After his tenure as the Chief Justice of India, Justice Khanna is set to retire on 13th May 2025. Which important cases has Justice Sanjeev Khanna adjudicated? He has participated in a number of significant cases. He granted interim bail to former Chief Minister Arvind Kejriwal, allowing him to participate in the Lok Sabha elections, underlying the significance of democratic participation. In a ruling involving Delhi's former